Hi, this is Elliot Eisenberg of Graphs and Laughs, here to catch you up to date on the latest in residential sales data for both Hillsborough and Pasco counties. And what can I say? You remain ridiculously inventory starved. If you compare inventory from a year ago, across the board in both counties, it's down with the exception of Pasco for single fam. It's up slightly, but not very much at all. We enter the spring selling season with absolutely nothing to purchase. In general, no matter how you measure, whether it's inventory or months to contract or median days on the market, inventory is crazy low and at or near all-time lows and continuing to decline. This is a really tight market. Now, a lot of you were very concerned about interest rates and what their negative effects will be on home price appreciation and so on. And yes, they'll certainly hit home price appreciation to some extent, but Tampa remains a remarkably hot market. You're the second fastest appreciating market in the country. And the lack of inventory is going to protect you from the impact of higher prices and higher interest rates. That's important to keep in mind. If we now pivot a little bit and look at the rest of the housing market and think about things like pending sales, yeah, they're down, but that's not surprising. There's nothing to buy and prices are higher and rates are up. If we look at sales activity, it's very much the same. But these activities, if you compare them to a year ago, are either flat to up. And if you compare them to 2 and 3 and 4 years ago before COVID occurred, they're well up. This remains a very strong market. And last but not least, year over year price appreciation is 25 to 30% in both counties. This is telling us that buyers really want to purchase. It's that there's just nothing out there to buy. Now, let's change our focus and look at the national economy. Q1 was clearly a dud. The first month of the quarter was wrecked by Omicron, and the last month of the quarter was wrecked by the senseless Russian invasion, which did damage to inflation and all kinds of cost of commodities and lowered GDP growth here and globally as well. The other thing to keep in mind is that we're going to have good growth the rest of the year. We should get at least 2.5% to 3% growth in Q2, 3, and 4, such that overall in 2022, we'll get 2.5%, maybe 2.75%, slightly above trend growth, certainly enough to get unemployment lower and keep job growth very strong forward, and that will also put pressure on housing markets. The big bugaboo for the economy now is certainly inflation. Inflation, no matter how you measure it, is somewhere between roughly 5.5% and 8.5%. The Fed has already begun to raise rates. The Fed will raise rates at the remaining 6 meetings of the year, the Federal Open Market Committee meetings. The next 2 meetings will have interest rate hikes of 0.5%, and the last 4 meetings of the year, the second half of this year, will have interest rate hikes of 0.25 point, such that by the end of the year, the Fed funds rate, short-term borrowing, will be 2 percentage points higher than it is now. But fear not. Long-term rates have already gone up dramatically. The rate increases that we have seen in the last several months are probably once in a generation, if not once in a lifetime. It's been 40 or 50 years since we've seen this. Rates are not likely to increase all that much going forward. Maybe they end the year at 5.5% to somewhere below 6%, but most of the hike has already occurred because the Fed's told us what they're going to do. Markets instantly react or quickly react. The last thing I want to talk about before I close is the fear of recession. Because inflation rates are so high and the Fed's going to have to raise rates considerably to slow down the economy, the fear is that when they do that, they drive us into recession accidentally. The Fed has been successful in raising rates and not creating a recession three times in the last 50 or 60 years. But generally, we end up in a recession. Not because they want to, but because it just works out. They raise rates, they can't see what's happening, there are lags in monetary policy, and bad stuff happens. I would not be surprised at all if we wind up in a recession. Between now and the end of next year, I peg the likelihood of a recession at least 35%. I'm going to be watching closely. I suggest you do, and we all know that the Fed will be. I look forward to seeing you next month.